afternoon, Big Eye of South Dakota. Thank you so much for inviting financial markets to participate in this virtual conference. Ed Bartling, I'm your internal wholesaler for financial markets. You know, this year, financial markets is a diamond partner, and we're very proud of that, and we look forward to a prosperous 2021. We hope that we're going to cover some educational things that will motivate you to look more into the life insurance arena. Before we get going, let me share with you this. I like to share at different times that I'm speaking what I call cowboy wisdom. And this cowboy wisdom goes like this. There was a young salesman, and the young salesman come back from a sale. So he went to the agency, and they asked him how to go. And he said, not very good. I thought I had the sale right up to the end. And then they said no. He says, you know, you can lead a horse to water, but you can't make him drink. And after a little while, an old salesman who was gray in the hair, kind of like me, came up to him privately. And he said, I heard what you said. And I kind of heard your pity party there a little bit. He says, you know, your job isn't to take the horse to the water and make him drink. It's to make him thirsty. Well, hopefully today, as we go through these CE courses today, that you're going to find little trigger points to bring up to your clients, to bring up the need. I realize that life insurance, you know, is quite a subject. It's kind of hard to bring up many times, but it needs to be done. Let me share with you an article that Carolyn Hofer sent to me. It's entitled, Breathe Life into Your Agency. And it says, if you're looking to grow your business, think of these four things. Life insurance is a natural extension of the home and auto. It helps you to be consistent. And technology has so much improved. And later we'll talk about things like called accelerated underwriting. And finally, life insurance can have a noticeable impact to your agency. The point being, more products that you have with your client, the stronger the relationship, and then retention remains much, much more stronger. So let's look at today's beginning of the CE course, that being understanding, participating, whole life insurance. As I started, I first want to thank you for the business that you produced in 2020 with us. In fact, you produced so much business that this year we started with the Big Eye agents of South Dakota that together, if you would obtain certain points, there would be a award granted at the end. And each and every one of you that wrote life business, then your name would go into the hat, so to speak. And that goal was 60,000 points. And you far exceeded those points. And the winner this year was a Missy Cook from Black Hills Federal Credit Union. Marketing wise on financial markets part, we were very pleased with that. And so we are pleased to announce, and maybe you've seen in the newsletter already, that for this year, we're going to continue the program. We're going to continue the program. And this program is then for an Alaskan cruise. It's for an Alaskan cruise. Now, departure in 2022, we won't know for sure the dates until September. But the goal of 60,000, we're going to still use that as our goal. So again, the aggregate of all your business, paid business, when we get to that 60,000 point level, along with the other qualifications, then your name will go in the hat. And just like we did this year, we will pull someone's name out. And of course, the more business that you write, the more times that your name will be in the hat. But we're very pleased to continue that program with you. CE, continued education. You know, it's been said that the purpose of education is action. That you do something that you learned. If I learn how to swim, it does me no good if I don't get in the water. So we hope that, again, today's sessions will motivate you to talk to your clients about life insurance. Share with you this little story. There was a gentleman named Jack, and Jack was an entrepreneur, and Jack's assets start to grow and grow and grow. And one of the assets that Jack had was this goose. This goose had special qualities. Maybe you've heard of it. This goose had the ability to lay golden eggs. And the more that Jack took care of the goose, the more eggs that Jack got. Now, let me ask you this. In advising Jack, being your trusted choice agent, would you tell Jack to just insure the eggs, or would you tell Jack to insure the goose and the golden eggs? Again, we're here today to help you explore ways that you can help find the need and take care of the need for Jack to insure the goose along with the golden eggs. After all, your clients are money machines. And the moment that they die, it stops. It stops. And we look here at financial markets then and carry that over to you, hopefully, is that, as it says here, our job is to ask about life insurance. Please don't make it our job to tell your family you didn't have any. You didn't have any. Participating whole life. Let's look at the situation here, the next slide here, the taxation of whole life. This is a little bit of a disclaimer here that I have to start with, in that as we make statements as the program goes on favorable tax treatment, we're making certain assumptions. And one main assumption is that this is not a modified endowment. Okay? And based upon the current tax laws, I'd say stand now. So under the current tax laws as they are, and as they talk about examples, we are immediately assuming that this is not a modified endowment at all. We understand in your P&C market that, that client retention, that client acquisition is very, very high. And I know your break-even point may be 2 years. And sometimes you have clients and you have customers. Your clients, you've built the relationship. Your customer, they may stay with you a year and then be shopping on the internet and then be buying elsewhere. Again, our goal today is to help you build relationships to make that into a client. And in doing so, then your break-even point is going to be far exceeded by them being a client of yours. We understand in your business that you are an SME. What I mean by that, you're a subject matter expert. And putting your toe in the water on life insurance may not feel as comfortable in being that SME. And that is where, folks, we think that financial markets can assist you there. Let me give you some examples of what I mean by that. Collectively at financial markets, we have those SMEs. When you submit life business with financial markets, it is assigned to a particular case manager. That case manager handles all of your business. It isn't going into a pool. So your CSR, or you have one source to be working with. With technology the way it is, we have the e-application, the e-policy, even the e-delivery now to have the convenience of that. We have a team of internal wholesalers, some of you may have been communicating with. Those internal wholesalers, their SE is to help you find the need and find the proper, let's say, arrow for your quiver to hit right on target there. There will be just one internal wholesaler working with you on those particular clients that you have there. That whole dedicated team is to work solely for you. They're to be on your team. And so we hope, again, that this helps build the confidence level that you can then explore the need of life insurance for your clients. And after all, you are their trusted choice, their trusted choice. We understand that there's a lot of infobesity out there that we suffer from. Honestly, your client, as well as you, are getting information. And again, being that SME, your client comes to you on the casualty needs already by letting us pull in the traces with you. And us being your SME, we're going to be able to help you on the life needs there. So today we're going to look at how does whole life insurance work, the different uses of whole life insurance. What's the benefit of a whole life insurance? And you may hear the phrase sometimes permanent versus a term insurance. And what are the types of whole life insurance that is out there in the marketplace itself? Okay. How does whole life insurance work? Okay. Well, it was entitled Participating Whole Life. So when we hear the phrase whole life, let's first start there on what we mean by whole life. For this discussion, we are speaking of a participating whole life policy. Let's carry it to the next step. What do we mean by participating whole life insurance? A participating whole life policy, as it states up there, is going to have some elements of guarantees. And it's also going to have some elements of non-guaranteed values. And those non-guaranteed values are going to be called dividends. And as we said, under the existing situations, non-MEC, it indeed has some tax advantages there over maybe some other products that are out there. The guarantees falls in maybe three areas: the death benefit, the premium, and cash values. There. Guaranteed rates. I said guarantee, one of the G's was premium. And this is how their actuary, so the actuary of the insurance company. When I say insurance company, I'm meaning particularly, this is a participating whole life policy that I'm speaking of. When the company that offers a participating whole life policy is a mutual insurance company. A mutual insurance company, when they incorporate, the owners of that insurance company are the policyholders. If you have a policy with a mutual company, then you are one of the owners of that policy. You will get annual notices on the board of directors to elect, anything, sometimes annual statements, and so forth that they're required to send. They will send to you being one of the owners of that insurance company, a mutual insurance company. On the opposite end of that is a stock insurance company. A stock insurance company, as for stock, we could maybe even go on the stock exchange and buy stock into that insurance. And sometimes when there are mergers that you hear of, a lot of those are stock insurance companies that other insurance companies are buying the stock of that insurance company. They get a majority of stock, and then they own the insurance company. And so we have within the United States some stock companies that are owned by other nations, such as Japan or France. That's an insurance company. Our discussion for the CE for today is a mutual insurance company offering a participating whole life. And I said the premium is guaranteed. And here's how the employee group called the actuaries build this premium that is guaranteed. They look at three factors in building the premium. And I call it MIE. They will look at the mortality rate, the rate at which then the policy holders that they have or potential policy holders will die within 1 year. And if they live that year, the next year and next year, the mortality rate that they have. Next be the interest rate. There is a certain interest rate that they guarantee the owner of that policy is going to receive. They get that in the form of the growth of the cash value. The actuary has to take that into account along with, it's a corporation, it's there to make a profit. They need to build that in there also. And also each state that they do business in, each state that they do business in is going to require them to set aside money called a reserve to take care of these guarantees. And one of the guarantees is the death benefit itself, the death benefit itself. This other MIE, the final one, is the expense factor. The expense from going to the suspect all the way to the policyholder. That process, which involves you and me, that whole process, what is the expense factor that the insurance company, the mutual insurance company, has to partake in? They believe in getting that. Now, think about it. Expenses. Technology has been able to drive expenses down. And many companies within the last year, due to the pandemic, expanded what a term we call accelerated underwriting. No blood, no fluid, not as many medical records, if any medical records, and still continue to do using algorithms and technology, the offer. When we get the offer, that then goes back to the mortality rate. They're saying at this gender and this health, this is what the actuary thinks the rate needs to be per 1,000 to take care of the G here of the guarantees. So that's how a premium is made. Every premium, they need to look at the mortality of their group. That's where the underwriting comes into play. The interest rate that they guarantee along with the interest rate growth that they're looking at, and the expense factor itself. The guaranteed value, and these values I said was the premium is guaranteed, the death benefit is guaranteed. If I buy a $250,000 whole life, participating whole life, it is guaranteed that the death benefit will be $250,000 when I reach, now it's age 120. Almost 50 years ago, that was 95. At age 95, that premium never changed. And at age 95, the cash value, the living value, that policy was worth $250,000. In fact, I remember working with a mutual company, and there would be occasions in which there would be a check drawn for the death benefit. The person did not die at 95. They drew them a check for $100,000. That policy, we called it, it endowed. It endowed, that policy did. So guaranteed death benefit, as long as you pay the premiums. A guaranteed cash value, it's guaranteed to grow. Remember that interest rate? So they look at that interest rate they guarantee, and they say this is guaranteed to grow. And in fact, it's going to grow now at age 121, whatever the death benefit was. So if the death benefit was 100,000, at 121, the living value, the cash value would be 100,000. Same at 250, 500, a million, guaranteed cash values. So those are the three G's I speak of: premium, death benefit, and cash value. Non-guaranteed values. Now remember, this is a participating whole life sold by a mutual insurance company, and a mutual insurance company is owned by the policy owners of their policies, the owner of the policy, which may not be the insured. It's the owner of the policy. So one of the advantages that explains here of a participating whole life policy is that we could get a growth, non-guaranteed growth, through dividends, Now, sometimes when you hear the word dividends, you think maybe of like the stock market. And I own a piece of stock, and I receive a dividend. That is not the same terminology when it is used in the insurance arena. Dividends in the insurance arena means it is a return of premium. Under the current tax situation, a dividend declared by a mutual insurance company is a return of premium. A return of premium. So once a year, the board of directors will look at their whole pool of business, and then they will look at overall those three factors. Those three factors of a premium was what? MIE. MIE, mortality, interest, and expenses. How many of our policyholders died within 1 year? How close are they to our calculations when we first sold the premium? Interest. What did we earn on the money that we invested, that we had the investment department invest? What was our return on those dollars? Knowing that we had to set money aside called reserves and other things. Expenses. Were our expenses lower than what we expected, or were they higher? After they look at those factors, the board of directors then declare a dividend. And a dividend is defined as a return of premium. So of the $1,000 premium that I paid on a monthly basis, of that $12,000 annualized, then a portion of that is returned to me, is return of premium. It's in the form of a dividend. When they return that to me, it is under the current law a non-taxable event, a non-taxable event. Let's look at how that dividend can be used. There are different options of the owner of the policy on what they want to do with that return of premium. What they want to do with that return of premium. They could, looking at the slide here, let me come back to the paid up additions on towards the end. They could get it in cash, just receive a check from the insurance company. It is a return of premium, non-taxable event. I could tell them to take the dividend, and when they take that dividend, they then put it in like a savings account, just like basically kind of like a bank, and they pay me interest on that. The interest, not the dividend, but the interest would be a taxable event to me. And I would get a notice on that once a year on the interest that was earned on that. I could use that return of premium to net my premium, to reduce my premium. I could say, take my return of premium and now apply it towards next year's premium to reduce that. And then they would reduce the premium. So it may be used to pay premiums. Let's go back to the top there. It could be used to purchase paid up additions, paid up additions. Let's take the steps on that. Let's break this down. I'm taking my dividend. So let's say that I get a $100 dividend, to keep it kind of simple. So I get a $100 dividend. I take that $100 and I tell the company, purchase me this year paid up additions, paid up additions. Let's break down what that means. First of all, going back, I said that premium is guaranteed. That premium is guaranteed at the age that I first buy it. So if I buy it at age 22, the premium would never change. It would always stay the same. When the dividend is declared, it goes and purchases for me. So it takes my $100 in my example, and it looks at my age today, and it would use my age today and take the $100 and buy me, you might think of a little bitty policy, a small little policy, and we're going to call that policy a paid up additions, a paid up additional policy. The $100 that was declared and given to me, and I told them to buy me paid up additions, maybe that $100 of dividends now buys me, say I'm young, $10,000 of additional insurance. So my $100 purchased me $10,000 of additional insurance, and that is paid up. The phrase paid up means after that first premium was paid, there's never another premium due on that. So I took my $100, it purchased $10,000 of additional death benefit guaranteed for the life of the policy. And that premium was only one time, that $100. And also, guess what? Get this, folks, that paid up additional policy, $10,000, it has a living value of $100. My $100 didn't disappear. My $100 now has a living value called a cash value of paid up additions, of paid up additional insurance. Now, that is a non-taxable event, non-taxable event. So if I had a $250,000 policy, God forbid I died after that dividend was declared, I would now, the beneficiary, have $250,000 plus $10,000 of paid up additional insurance. If I wanted to look at the living value, that $10,000 of paid up additions would also have a cash value of $100. And it's got a cash value growth also. At 121, it would be then worth $10,000. And also, folks, itself has dividend, it's eligible for its own dividends. That $10,000 is eligible for dividends. So you can see the multiplier effect that can take place with paid up additions. Now, the last one on this slide, you see it says dividends may be used to purchase additional term insurance for some policies. This sometimes is called the fifth dividend option. The fifth dividend option. I said one of the G's with the death benefit was guaranteed to 120. I said another G was that the cash value was guaranteed to a Dow at 120, equaling the death benefit. Some of the negatives you may hear on participating whole lives would be, well, if I die and at the point of my death, the cash value of the policy was $20,000 and the death benefit was $250,000, my beneficiary is only going to receive $250,000. The company is going to keep that living benefit called the cash value. Death benefit is only $250,000. If that is an objection, then your SME, our internal wholesaler, could suggest the fifth dividend option. The fifth dividend option, when the $100 dividend is declared, they will look at their attained age and buy them 1 year of term insurance. That term insurance is very cheap, particularly at the younger ages, and it's equal to, and it changes every year, it's equal to the cash value. So of that $100, there may be $2 that's used to buy term insurance. The term insurance for that year is $20,000. The rest of that $95 or $98 goes towards paid up additions, as that being the option there. But they use part of it each year to buy 1 year of term insurance at their attained age, equaling the cash value. So if I have a $250 with a $20,000 cash value, death occurs, my beneficiary gets $250 plus the 20, and the rest, the paid up additions, which would also increase the death benefit, also increase the death benefit. So the paid up addition options then, but each year the board of directors will declare that they are going to pay dividends. Now you can imagine, I said it was mortality, interest, and expenses. What's happened to interest lately? That's gone down, hasn't it? So depending on where maybe different pools of investment that mutual company may be, it could be, and they look long range, it could be that the dividend may not be as high as it has been in the past. They'll, of course, take that into account there. Now, it could be a point that your paid up additions are so high there that they could be used to offset the premiums at times. That would take a match and to look at that. And remember this, dividend is the non-guaranteed part of a participating whole life. Dividends are not guaranteed. Dividends are not guaranteed. They are declared each and every year by the board of directors. Okay. The tax advantage, it's income tax free death benefits. A tax deferred buildup of the cash values. The cash value is going to grow to 1 and then endow, be equal to the face amount. While that growth is going on under the current tax laws, that internal growth is not a taxable event to you at all. Not a taxable event to you at all. This is an asset that your policy owner has, your client has. As such, they could access the living value. And that living value could be in two parts. One would be the cash value of the policy itself. The cash value could be taken out in the form of a loan. A loan, many times the interest is guaranteed at a fixed rate. Other times it may be at a variable rate, depending on the policy itself. Or it could be that you're going to take out the return of premiums in the form of the dividends. So if my dividends was in paid up additions, buying these little mini policies every year of additional death benefit, paid up additional death benefit, that is a whole life policy that it's purchasing. So it has a living value, it has a cash value, and I could withdraw just dividends. If I withdraw the dividends, as long as I don't, it's in a first in, first out basis, then it would be just a return of my return of premium. And the withdrawal of dividends typically are not a taxable event to you. When I take the loan, when I take the cash value in the form of the loan, that is a non-taxable event to you. Now, 1 year from the anniversary of the policy, when you took that loan, you would get a notice and you would then be asked to pay low interest, pay that loan interest on that amount that you borrow. If you don't pay that, it would be added to the loan and it would just start to draw down on the death benefit. You see, if death occurs, then there'll be kind of a snapshot and they will ask, okay, what's the death benefit? What's the paid up additions? Was there 1 year term in place? Is there any loan on the policy? If there was a loan on the policy, then that loan would then subtract from the death benefit before the beneficiary would be paid. How about some uses of a whole life policy? Uses of a whole life policy, one can be the human value protection, family protection, income protection, right? That goose along with the eggs, the goose along with the egg, that money machine. Business protection itself. You could have a key employee. You could have a key employee, provide them with a policy that has the growth of guarantee and potential, being a whole life policy. And with a term called executive bonus, you could be taking the premium, Mr. Employer, off as a deduction because I'm increasing her salary by that much, bonusing, but then she uses it to purchase herself a permanent policy. And I could even say something as advanced as, and again, your internal wholesaler, that SME could help with those needs. Something called a split dollar, where I, as the employer, then at the time of death, I would get back my premiums. And then they would be able to take with them when they retire, the living benefit of the cash value. They say, well, if I'm going to get back my premium and they're getting the cash value, and particularly if they die, my beneficiary is not going to get as much. Yes, but we'll put on that fifth dividend option, which then the cash value is also increasing that death benefit by the purchase of that each and every year. Estate planning. Let me ask you this. I think the estate tax exemption now is around 11.5. In the year 2025, it's going to revert back to, I believe, around 5. Just this week, folks, Senator Sanders, he's putting in legislation that is going to be reduced down to 3 million, So do you think your clients maybe be faced with a need for estate planning? You as a trusted choice agent, you can help them there. Asset maximization. It's owned by the client. That's who owns this policy. That is an asset to them. And they can use it at any time that they need it. Here's an example of a human life protection. Say we have a 35-year-old and they're making $100,000 a year. And they're going to make that assumption all the way for 30 years. As I said, they're like a money machine. There's a certain lifestyle and certain goals that they have for themselves, for their children. That income protection, that human life value protection needs to come to the forefront. And it can be covered by a participating whole life, which then grows, maybe as the cost of living grows also. Family protection, such as for mortgage protection, their mortgage. Education funding. You know, you could set up a college funding plan. And in doing so with a permanent participating whole life policy, and when they go to complete for college aid, right now they apply for college aid, that life insurance policy would not need to be included. And yet, what an asset that we'd have there. What an asset that we'd have there. And it's not too early to think of permanent participating whole life for children. And you know, I think at times, sometimes parents maybe don't want to do for their kids as they get older when they're out of the house as much as they had before. But you know, grandparents love to do for their grandkids. And what a gift, a legacy gift, than setting up an education funding plan of participating whole life. Ask your internal wholesaler about some information on that. Income needs, maybe at retirement, where we start the plan now, and then at the point of retirement, we know we're going to start taking maybe some of the paid up additions or some other structure that we're going to set up there. Your internal wholesaler, that SME, subject matter expert, can help you. Business protection, whether that be farm and ranch or small business. Some of the clientele that you may have there, they may need protection of covering the needs that you can uncover for them. Be buy-sell agreements. I'm going to turn it over to the next generation. Do we have a buy-sell agreement set in place? How about funding supplemental retirement programs? Again, I bought it early enough and let the miracle of the paid up additions, the multiplier effect, take place. And I can use it for supplementing retirement. Key person insurance. There was an organization in Sioux Falls. Maybe you know of them. Fisher Rounds. They had a client, and this client, he bought a bunch and set up and was building apartments in Sioux Falls. Apartments being built right and left. That particular client of Fisher Rounds had a key person, a key employee. You see, she was in charge of filling up and leasing those apartments that were being built. And she had to go through the gleaning of who to rent the apartment to and who not to, and making sure that it was taken care of, setting up the leases. very much a key person. We were able to work with Fisher Rounds and provide key person insurance. And at first, the insurance company wanted to know, why is this young person needing this much death benefit for this employer? With the aid of their internal wholesaler and writing a very detailed cover letter, we were able to satisfy underwriting department on how important that key person is. That key person is. Next one, payment of loans and mortgages. Pay loans off. I've been around the business a little bit, almost close to 50 years. I'm a member of a business owner in South Sioux City, Nebraska. He owned a bar restaurant close to the racetrack that was there in South Sioux City. He would come in, well, he would call ahead of time and he would say, I want to use the living value of my 5 insurance policies. I want to take loans on those. Now, the loan rate, folks, at that time was 2%. He would take loans on those policies. He would pick up a check from us for the full loan amount, and he would use that money. Usually by the end of the year, he would call us and say, I want to pay my loans off. You see, he was using his cash value, his living value of his policy to do different investments, transactions, whatever they be. And then he would come right back and pay those loans off within a year. And the loan interest on that was only 2%. He had that check from that insurance company within 5 days. He did not have to sit down in front of a banker in a cubicle and explain why he wanted to borrow the money. It was available to him right away. 43 years ago, in June, a tornado destroyed the town that we lived in then. Totally destroyed our home. What do you do? Probably what maybe the Schroeder fire people are thinking right now. We called our insurance company, and within 2 days, I had a loan on my participating whole life policies that I could see to protect my family. It's there for protection, folks. It's there for protection. Also, before I leave that key person and that business protection, write this down. Be your own banker. Be your own banker concept with participating whole life. Ask your internal wholesaler about that. The estate planning, as we said, do you think the taxes are going to go up or the taxes are going to go down? Do you think the exemption is going to go up or do you think the exemption is going to go down? Boy, looking at the horizon, I would say that at least by 2025, it's going to go down to 5, and maybe earlier, it's going to go down, maybe lower, folks, lower. You're the trusted choice. Your clients, your farmers, your ranchers, they need to be talking to you. And this death benefit then gives the liquidity needed for that. It's able to then set up such things as what's fair and what's equal in dealing with maybe some family members are working on the farm ranch and others aren't. All of that is be able to be taken care of. And finally, maybe there's a need of special needs, setting up a special needs trust and using permanent life insurance to take care of that. Asset maximization. In this living policy, this cash value, this very extremely important asset, they can use that at their will, be their own banker, set up charitable remainder trust, set up to go to a charity. All of these things can be set up by the use of permanent life insurance, participating whole life insurance. We have quite an array already of participating whole life policies. A little tidbit here, we're looking on the horizon, maybe by the end of this year, that we'll be bringing on another carrier that has a participating whole life policy. We understand at Financial Markets the importance of the participating whole life policy and its different needs that we're covering here today. Life insurance, by having those 3 G's there, it gives that policyholder to use the funds as that they would otherwise have to manage themselves or pay someone to manage those funds. You can imagine with those 3 G's there, that those actuaries, they invest that money in the investment department in some very conservative funds to make sure that the guarantee is there, Pension maximization, yes, you can use a permanent participating whole life policy, which then can allow that person when they're there, and that person could be a key employee of yours. They are really key to the business, and you're kind of providing, you might say, a little bit of a golden handcuff. Saying, if you stay with me, you're loyal to me at this stage, then look at the pot of gold at the end. A little bit of a golden handcuff there. Now that has to be set up just certain ways. And from owner to beneficiary to premium payer. That's kind of a triangle, and it has to be set up in a particular way. Your internal wholesaler, part of your dedicated team there, they have the wherewithal, they have the knowledge to make sure that that is set up in the proper way when something as important as pension maximization comes into play. A charitable remainders trust is then the trust gets involved in being the owner of the policy. And as such, then we're able to then bring forth income to the person the person setting up the trust, and then the remainder of the value then can go to that charity that they have in mind. And charities, along with other organizations, maybe had a tough year last year. So they're looking for means to expand their horizons of their beneficiaries that provide with them with funds. A charitable remainder trust using a permanent whole life policy can be one of those sources. Disability protection. There is a rider that we can put on the policy, and on that policy, it can provide that if they become disabled, the premium is going to be paid on. But also, the need for critical illness, the need for, if they go into a long-term care facility, they satisfy the ADLs. That is available now on our policies, along with terminal illness. Liability protection, state of South Dakota, life insurance is then protected. In fact, the other 49 states also. Similar to a will, in that beneficiary, it will go as you declare. You could say that you want them to receive of a $100,000 policy only to receive $10,000 a year. That can be set up. That you want them to get 100%. You could say that you want 2 people to share 50-50 and be their heirs, if they weren't living, would get that 50%. All of those little intricacies, it sounds very difficult to understand, but it's not, folks. And we're here to help you uncover some of those needs. You know, when was the last time that you even maybe asked your client, have you had your beneficiary reviewed? Maybe of the group insurance that I sold you, maybe of your personal insurance, maybe of your retirement plan. Has any of that been reviewed? And is it up to date? Maybe you had a daughter that got married. She has a name change, but it hasn't been changed on the documents themselves. Beneficiary review is a good door opener to be able to go in and do a risk review for your client. We have some excellent resources that you can use to do that. As I said, under existing law, it is a tax-free death benefit. And that cash value, as it grows, that cash value grows, it grows tax deferred. That is that benefit of having the cash values itself. And dividends, they can come out tax-free. You have access to that cash value in the form of, you could totally surrender your policy if you so wish. You also could, as I said, take a loan on the policy. Or you could reposition your policy. You could take the living value of this policy today and move it to another policy if it fell under what they would call a 1035 exchange policy. And you can reach a point where the risk has already been taken care of. You no longer need the life insurance. That we have is called a life settlement. And folks, we have the resources for a life settlement. Contact your internal wholesaler. It's an asset, so it can be used as collateral for a bank loan. You know, if your clients are getting those EDIL loans, if it's $50,000 or more, they have to have that covered by collateral. As I said, the paid up additions increase the death benefit. There can be a level premium and there can be a 20 pay, 10 pay. A lot of times the 10 pays and 20 pays are done for the juveniles. So grandpa buys it, pays 10 premiums, and then there's no longer a premium at all due on the policy. As I said, this is a participating whole life, so it's a level premium. Our limited payment plans are for the juveniles. I know we covered a lot. I thank you very much. If you want to send me some questions, it's edward.bartling@fmiAgent.com. edward.bartling@fmiAgent.com. I thank you very much, and I believe I'll get the list of the attendees so I can get your CE certificate sent to you. Thank you very, very much.